Hello everyone, welcome to my lecture on Unit 5 Topic 4 Types of Ratios. Profitability Ratios. Profitability ratios throws a light on how well a firm is organizing its activities in a profitable manner. As the owner expects a reasonable rate of return on their investment, the firm should also generate enough profits not only to meet the expectations of the owners but also to finance its expansion and diversification activities. So here are listed out 8 ratios which makes the firms to assess its profitability. The first one is gross profit ratio, operating ratio, earnings per ratio, as well as price earning ratio, net profit ratio, return on investment, dividend yield, as well as earning power. Gross profit ratio. Gross profit ratio is ratio between gross profits to sales during a given period of time. It is expressed in terms of percentage. Gross profit is equal to gross profit divided by sales into 100. So here is a small problem given us for which we are supposed to calculate the gross profit ratio. Cost of the goods sold, net sales 50,000. Cost of the goods sold is 20,000. The gross profit is to be calculated. So generally the formula for calculating the gross profit is cost of goods sold is equal to sales minus gross profit. It can also be written as gross profit is equal to sales minus cost of the goods sold. So these two figures are given for us. One is 50,000 and one is 20,000. So the gross profit is 30,000 here divided by sales formula for gross profit ratio into 100. That is 60%. In other words, 60% of sales is gross profit. Net profit ratio. It is the ratio between the net profit after taxes and net sales. It indicates what portion of sales is left to the owners for operating its expenses. Non-operating income such as interest on investments, gain or sale of fixed assets and so on are added to the operating profit and non-operating expenses such as loss on sale of fixed assets and so on are deducted from the such profit. So what is the non-operating income is the income which is generated out of the core business operations. Similarly, the expenditures which are incurred out of the core business operations is called as non-operating expenses. This is a net profit after adjusting non-profit income and non-profit expenses. So net profit ratio is the formula: net profit after taxes divided by net sales into 100. Here we are going to see how the net profit ratio is calculated. Suppose the net sales is 50,000 for a firm and the cost of the goods sold is 20,000. The details of the expenses are given below. Administrative expenses 4,000. These are all the relevant information. Selling and distribution 4,000, loss and sale of fixed assets 3,000, interest on investment 2,000, and tax rate is at 10-20%. So here is a statement which is to be prepared in order to calculate net profit after taxes. So to begin with, we'll start with the sales less cost of the goods sold. Sales and minus less cost of the goods sold. The this value, the resulting value is your gross profit, against which non-operating expenses are to be deducted. So the given items in the problem are, in the data is, non-operating expenses are selling distributed expenses and administrative expenses. So minus 4,000 it is minus 8,000. So deducting this figure, we are going to get it as 22,000. This is nothing but your net profit, right? So against, we are going to add non-operating incomes to this. So here it is interest on investment falls under that category. Added, once added, this figure is added, your resulting value is 24,000, from which loss and sale of assets is to be deducted. And the resulting value is 21,000 is your net profit before taxes, on which you are supposed to calculate 20% tax rate, coming to the extent of 4,200. After deducting it, this is the end figure, that is 16,800. It's nothing but your net profit after taxes. So it can also be represented as net profit after taxes. Next, operating ratio. Operating ratio is formula is operating expenses divided by net sales into 100. It is a ratio between cost of the goods sold plus operating expenses and the net sales. Higher the ratio, the lower is the profitability, and vice versa. Whereas operating expenses are calculated by considering all these aspects: cost of the goods sold, administrative expenses, selling and distribution expenses, etc. So here ABC company's details are given for us, for which we are going to calculate the operating ratio. Net sales is 20 lakhs, cost of the goods sold, operating expenses including cost of the goods sold and everything is 14 lakhs. The ratio is, substitute the given values in the formula, operating expenses divided by net sales. So 14 lakhs divided by 20 into 100 is 70%. Return on investment. Return on investment is one of the very important parameters affecting the business plan. The profitability of the firm is measured in terms of return on investment. It refers to all the total assets, capital employed, and owner's equity. This is a formula. ROI is equal to net profit after taxes divided by total investment. We just now learned how to calculate the net profit after taxes, right? The same procedure has to be followed here also. And some of the important ratios under this head are return on capital employed and return on equity. Return on capital employed is adjusted net profit divided by capital employed. It is a satisfactory measure which reveals the overall performance of the firm in terms of profitability. ROE, it is net profit minus dividend payable to preference shareholders divided by equity share capital. Higher the return on equity is, the more is the profitability of the firm, and vice versa. Earnings per share. Earnings per share is related to relationship between the net profit and the number of the shares outstanding at the end of a given period. It is compared to previous years to provide a basis for assessing the company's performance. So EPS is equal to net profit after taxes divided by number of shares outstanding. So for a given number of shares, that is 10,000, and the net profit after taxes for a given period is 4,50,000, calculate the EPS. Substituting the values in the formula, EPS is arrived at rupees 45. Higher the EPS is, the more likely to be the demand for the shares of the company. However, it is to be noted that EPS is one of the many affecting the demand for a given share. Dividend yield. Yield refers to the amount of total return on investor who will receive for a given period of time for the amount of his investment. Dividend yield refers to the percentage return on the price paid for shares. So this is the formula applied or used for calculation of the dividend yield. It is a nominal value or a face value of the share divided by the cost or market price of the share into percentage of dividend per annum. So here the face value of the share is the initial price of the share at the time of issue. Generally, this will be decided by the firm, whereas market price means the price of the share listed on the stock exchange. Generally, this will be higher than the face value of the share. So for the given, here is a small example given for us. Given that the current market price of a share is 300, face value of the share is 100, dividend declared is 20%, find out or calculate the dividend yield. So applying the formula, face value of the share divided by market price into rate of dividend. This rate of dividend is given as 20%. So this has to be calculated on the face value. Calculated on the face value of the share. There is another alternative formula, that is dividend yield is equal to annual dividend divided by market price of the share into 100. So applying this formula and substituting the values, we'll get the dividend yield as 6.66% per annum. The higher the yield reflects the investments are riskier. Lower the yield refers safer are the investments. So the general yardstick, so in general, yield and risk are inversely proportional. Price earnings ratio. Price earning ratio is equal to market price per share divided by earnings per share. So market price, for example, if it is 340 rupees, earnings per share is 10, calculate price earning ratio. It is market price divided by earning price. It is rupees 34. Thus, a share with a market price of 340 and EPS 10 would have a price earning ratio of rupees 34. With this, I'll end up the session here. Thank you.